Hello everyone, my name's Justin Smith and this is my accounting 311 database project. For this project I chose to do JPMorgan Chase Company, Bank of America Corporation, and Morgan Stanley. Let's get right into it with some quick facts. All these companies are in the financial services sector. Companies in this are, banks, asset managers, credit services, investment brokers, insurance companies, and many more. There's, 1,418 companies kind of in the sector, and some other companies kind of outside what we're talking to today is Visa, Wells Fargo, BlackRock, PNC, PayPal. As you can see, it is pretty diverse. So the first company we're gonna get started with here is J.P. Morgan Chase and Company. Just a quick little overview. JP Morgan operates in three main segments that they like to call consumer and community banking, commercial and investment banking, and asset and wealth management. Consumer banking, that's like me or you kind of walking into the to a local branch and doing whatever business we need to do there. Commercial and investment banking kind of helps corporations really raise money for whatever sort of products or projects, sorry, that they're looking to complete. And then asset and wealth management, it'd be like me or you going to someone with a portfolio of cash and be like, hey, how do we kind of make this money work for me? They were founded in 1799 and they're currently headquartered in New York City, New York. They have 318,000 plus global full-time employees, so they are a worldwide brand. And last year they did $168.73 billion in revenue. So let's get started with liquidity ratios. I'm going to turn my little laser pointer here on just so we can make things a little bit easier to know what I'm talking about. So on the left here, we have the operating cash flow ratio, which kind of demonstrates how many times a company can pay off its current liabilities with cash generated. And as you can see, JP Morgan has had a rather rough time with this ratio, starting really negative, going up almost the same degree in the opposite direction the next year, climbing a little bit, and then a steep decline again. But as you'll see through the rest of this presentation, they're really not an outlier in that degree. Um, again, cash from operating activities and cash flows in general have been probably really affected by out economic landscape and the state of the markets, especially kind of rebounding from COVID here. So it'll certainly be interesting to see, kind of zooming out, maybe looking down a couple years down the line where it starts to even out at, again with rising costs as well. And then on the right here, we have the current ratio, which roughly represents how much a company could pay off its debts with all the short-term assets it holds. And again, um, JP Morgan might have trouble paying off some of their debts up front, but they're not an outlier in this industry, and we're going to talk a little bit about why that is later. Some of our solvency ratios here. We have debt to equity ratio, which kind of compares how much a company is being funded by debt compared to shareholders' equity, just by dividing debt by the equity. I mean, as we can see, JP Morgan is very high in this. They're clearly very much funded by debt. But again, this is common in the financial services industry, especially with a huge bank. And as I said earlier, we're going to talk about why, and that's because when you think of your own balance sheet, right, you have your assets, what you own, and your liabilities versus, which is what you own, others, and your shareholders' equity, right? For banks, that is a little bit flip-flopped here. So, I give a money to a bank. A bank can use that to make whatever money by giving out loans, other banking activities, and um, but I can always withdraw that. They always have to have that ready for me to withdraw. So that is why it's seen as a liability, which would be considered debt, even though it's not in the same way that we might think. And over here, times interest earned, which kind of represents how many time a company could cover its current interest expenses, with the assets and cash flows they have. As you can see, JPMorgan had, a pretty solid 6.29 and at a real peak up to 15.82, but then since then has been seeing a pretty steep decline. And I think this can be explained by fluctuations in recent interest rates, hikes in prior years bring up the cost of debt, just other economic factors. Next, we're going to talk about some profitability ratios. JP Morgan's return on equity has steadily grown since 2020, and return on equity is kind of showing how efficient and how well that shareholders, dollars of equity are being used to generate profits for the company. And due to its size and the realm of business that they have, 17% return on equity is stellar, and I think most investors would be happy to have that. Um, Now looking at operating profit margin here, this kind of shows how much revenue remains intact after paying for, the business expenses. As you can see, it is slowly declining over time, and I think that can be attributed to the rising costs of running business. Um, with people working from home from about 2020 to 2022, it kind of remained stable, or at least at a higher level because again, people were working from home and you didn't have to pay to run an office space. 2021 here, this is kind of the peak of the work from home era, which would explain, much less costs and higher profit margins. But now, as you see, it's starting to kind of decline with people coming back into office, and I think that is a huge reason why, costs are up and profit margin isn't where it maybe needs to be. Now we're going to talk about market value ratios. In the stock market, a very valuable metric for kind of company success is earnings per share, which represents how much a profit each share of stock is kind of helping the company generate. As you can see, it's climbing over time, which is always a good thing to see. Each of their outstanding shares, which if you didn't know, you just calculate kind of the total earnings and dividing it by the shares outstanding, and that's kind of how we get this number. Which means that their, shares of common stock are very much positively contributing to the company. And for price to earnings ratio we have right here, it represents how much investors are willing to pay for a single dollar of the company's earnings. It is a good thing not to kind of have too much of variation. I would say, having this 14.29 with a low of 10.29 and having most of the values kind of in between there, that's pretty stable. If it varies too much, it may indicate that investors are either overvaluing the stock if it's too high, or if they have negative beliefs about the company, it's too low. Again, it's how much they think that a dollar of the company's revenues is worth, or earnings, I guess. And again, you calculate this by taking the current share price and dividing it by the earnings per share, and you can do it vice versa and do a quick calculation of the stock price if you multiply these two values. All right, next we're going to talk about Bank of America Corporation. Sorry, they trade on the New York Stock Exchange under the ticker BAC. Just a quick overview of Bank of America. Their main operating segments are consumer banking, which is again, you and I walking into the bank doing our business. Global wealth and investment management, again, kind of giving funds to these companies to manage, investments and, tax purposes and, a variety of different solutions. Global banking, global markets, which is, just dealing with companies kind of around the world. Whatever banking needs they may have, whatever sort of, investment or trading or security stuff that may be done across the globe. They were founded in 1784, which means they're almost older than the United States of America, which is really crazy to think about. They're headquartered in Charlotte, North Carolina, and have 212,700 full-time employees across the globe, with revenues of about $97.45 billion in 2024. Now, again, looking at the liquidity ratios, it's kind of the same story here with the operating cash flow. Maybe a little bit more fluctuations kind of over the years here, but again, it doesn't really reach too high, and it does often get negative. And I think it's going to be a common theme. Again, we're going to see that with Morgan Stanley a little bit. It's just kind of how it works within the financial services sort of industry, especially when you're a company like Bank of America and the way that you operate. Um, there's just a lot of factors kind of going into play here. And with the current ratio, it's the same story, kind of not exactly getting to where we want to see above, that one mark, kind of hanging out around 3/4 to about 0.85, which again, kind of putting it in the context of all three companies isn't really too bad. Um, but again, there are things in place that will prevent all their kind of debts from being called in the form of deposits and accounts. So it's still a pretty safe company. Now for solvency, we're going to see the same thing here with debt to equity and Bank of America. They are still kind of around that 10 mark here. Again, with their kind of special liabilities, as we talked about, it does keep them, higher than we would like to see. But again, that debt and the accounts from people like you and me and corporations and investment accounts, like that's what's keeping them alive. So we kind of have to take the scariness of these numbers and put it into the right context. And again, with the times interest earned, we see a pretty decent number here. The big climb in 2021 and then a fall off as well. This one may be a little bit less extreme than JP Morgan. But again, we do start to see some struggling here, kind of getting under that one mark, which is not exactly something that you want to see. And then for profitability ratios, again, return on equity, it's kind of hovering around between like 7 and 12% here, kind of a little bit towards the higher end of that range. Um, Again, these numbers, while they're not as high as maybe JP Morgan, it does kind of fall right in line for what we'd expect for maybe a company that doesn't do as well, but still, pretty good for themselves, pretty good shape. And then operating profit margin. Again, we're seeing a pretty middle of the road here, and then a incline in 2021. Again, everybody was home, costs were a little bit down, and then starting to taper off again as costs begin to rise. People come back into office. The market value ratios. The earnings per share again doesn't seem to be really high for JP Morgan, but honestly, this $3 range from my viewing of some other companies, it does not seem to be too extreme in either direction, either too high or too low, and kind of staying that maintaining what they're doing. They're probably more often dishing out new shares because there is, revenue growth. But as you can see here, the price to earnings ratio was pretty high at 16.12 and has, started to decline with a little bit of a rebound since 2022. And again, that could be due to a multitude of factors. Maybe investors weren't so keen on them, starting kind of around this point and have started to pick back up pace, or I would say their average is probably lying somewhere between 11 and 13. So they're still, pretty stable, and maybe a few down years, maybe indicating kind of what's going on here, or again, just normal fluctuations in the market given the conditions after and during the pandemic. And now we're going to be moving on to Morgan Stanley. They trade on the New York Stock Exchange under the ticker MS. Again, a quick little overview. Their main segments are institutional securities, wealth management, and investment management. Um, Again, institutional securities, this is sort of dealing with the trading and underwriting of securities from corporations to raise money. We talked about wealth management and investment management. These kind of go hand in hand a little bit. As we talked about already, they were founded in 1924, so they're certainly a much newer company, believe it or not, than the other two that we spoke about. And they're headquartered in New York City, New York, with about 81,000 full-time employees across the globe. And last year, the revenue was 63.96 billion. All right. So let's get started with some liquidity ratios. Again, their current ratio has, just been kind of falling in line, maybe a little bit of the lower end compared to the other two companies that we already discussed, but it's still kind of well within that range, about 3/4, 0.8. It just seems to very much be a trend for this industry. And their operating cash flow Again, just fluctuations, pretty down to big ups and then down and up. And there's just been so much fluctuations kind of within the markets that would maybe affect, these types of companies a little bit more, just due to the nature of their business as opposed to, let's say manufacturing or just other, more staple products that people would provide. Their solvency ratios, again, kind of right in line there with the debt to equity, leverage at about 0.10. Um, Maybe a slight decline in 2024, but we'll have to wait to 2025 to see if that continues to be a trend or not. It does seem to be a little bit of a peak with, rising in 2023. Hopefully it can start to come back down a little bit. And times interest earned, it's the same story. They don't dip as low as Bank of America, but they start at a decent level, they peak pretty high, and then they start to go down again. And again, I think it can be definitely explained by interest rate fluctuations and other things affecting the cost of debt. Um, and profitability ratios here, return on equity, it hasn't really seen significant growth here over time. I guess if you were to sort of compound it, it would show that there's growth year over year, but the chart kind of explains otherwise. And again, I think this just could be infected by market fluctuations and stuff that's really out of a lot of the employees and managers' control. They can't, say what the market's going to do. They can only hope that they can predict it and try to act ahead. But their operating profit margin is telling a little bit of a different story here, with increases from 2020 to 2024 of, what is that, like almost 15, 16% over time, which is great to see that they didn't really get hit as hard with the work from home kind of returning to office, and they've actually been able to recover and continue to realize more of those earnings after their expenses. Um, and finally, going back to the market value ratios, their earnings per share does seem to kind of fit perfectly in between JPMorgan and Bank of America Corporation, with kind of steading between $5 and about $8 a share. I would say the average falls maybe right about here. Um, and again, that just means they're providing enough earnings for the amount of shares that they have outstanding, and investors do still have that belief in them, positive belief. I would say their average is probably going up over time now with these gradual increases instead of huge fluctuations. At the peak of 17.8 in 2023, I would say investors had a much positive outlook as they did in the past. And then, just the law of averages stuff is going to come down once it comes back up. So, it is still pretty significant growth over time, which is good to see that investors are continuously more optimistic about this company. Now let's get to some comparisons. Let's compare the liquidity ratios here first. Let's talk about the operating cash flow. As we can see, this stuff is just all over the map. With JP Morgan seemingly having the biggest range, and maybe if you break it down on paper, a little bit more volatile compared to the other ones. But I think that's just because they really don't move as far when they move. JP Morgan really seems to swing either way like a pendulum. And then current ratio, again, I kind of told this story throughout the presentation here, but they're all just pretty much in line. A lot of fluctuations with JP Morgan at the top just about every year here, with Bank of America kind of fluttering in between, and Morgan Stanley kind of bringing up the rear, but at points having times where they just maybe are a little bit more liquid at the time. Insolvency here, their debt to equity, as I've been saying this whole time, they are pretty much about in line with each other. Again, this is, if you were to remove the context, remove the companies, you would maybe be a little bit horrified at what you're seeing here, with seeing how much debt that they really have that is funding the company. But again, we got to put in that context of the consumer accounts being considered liabilities. And the times interest earned, they all follow the same trend as well. With Morgan Stanley kind of having the bigger swing here, JP Morgan and Bank of America actually, I guess, having a little bit of a smoother trend line, even though it all follows the same degree. With profitability here, their return on equity, again, it's not as close as maybe it seemed when I was going through the charts originally, but it's still, they all kind of hang in line, with definitely fluctuations over time, but again, kind of mostly staying between zero point 0.1 and 0.16, with Bank of America just a little bit lower over time. And operating profit margins, again, we see JP Morgan kind of in the lead for the first 3 years here. Morgan Stanley sort of picking up the pace, but again, they're mostly staying kind of in this range. Bank of America has some years where it's better, and then recently maybe hasn't been doing so well, um, which is definitely interesting to see. And then lastly here we have the market value, their price to earnings. Well, there is a good bit of fluctuation, kind of staying between that 18 and 10% or 10 range here. Just kind of goes to show, I would say the average for this industry is probably going to be between 12 and 14, and they're all, maybe even a little bit lower, maybe between 10 and 13, right? To where they're all kind of at that point. And maybe Morgan Stanley had a really good forward-looking year in 2023, and same with Bank of America in 2020. And again, fluctuations are normal within the market because investors are going to feel however they're going to feel. And kind of going to earnings per share, it's, as I was explaining, JP Morgan just kind of seems to always be at the top, with Bank of America surprisingly kind of being towards the bottom, and Morgan Stanley sort of, being in the middle here, maybe not as average between the two as it could be. Um, and I will say it's important to note that historically, Bank of America does tend to trade, their stock does tend to trade a little bit of a lower price, actually a decent bit of a lower price compared to JP Morgan and Morgan Stanley. So you might be wondering, why I didn't include any activity ratios, and that's because none apply. Banks, financial institutions just simply have no inventory to use for calculations. That's why I didn't have a quick ratio either. There'd be no point in doing the asset test, because there's no inventory to take out of that current liabilities over, or current assets over current liabilities equation. So it would really just be, a waste of time when it's the same thing. Um, and kind of my conclusions here at the very end are JP Morgan seems to still kind of carry the most value for investors. It might not see the most growth in its stock price and the value of the investment, but it's going to continue to kind of have that excellence. And while Morgan Stanley and Bank of America might fight it out at some occasions, JP Morgan is usually, still kind of the head honcho out of these three. But I would say the companies are appropriately similar. They follow a lot of the same trends over time. They kind of traded a lot of the same averages and different statistics there and ratios, which is something that you really want to see again when thinking of three titans of the industry. Um, and again, financial services, it seems as though they're characterized by a high debt to equity, again, due to the structure of the way they do business, and low operating cash flow ratios compared to, again, maybe a company like Walmart or McDonald's or Starbucks. They would definitely look a lot different. And Morgan Stanley is definitely improving. You might want to take some of their historical context and zoom out, but it seems as though Morgan Stanley is on the upswing, at least compared to a company like Bank of America and maybe even a little bit of JP Morgan. Maybe Morgan Stanley is looking to carve out some more market share. I want to thank you for listening to my presentation today. It was an absolute blast, kind of getting to talk about these companies and kind of what I found over time, and I hope you enjoyed. Have a great weekend.